Your lease renewal lands and the rent jumps again. Yet your street feels the same. Same coffee line, same gym crowd, same for lease signs. Then your delivery app adds a new service fee, like it grew overnight. You're not imagining it. Prices can move even when the neighborhood looks still. So, what's pulling the strings if not your local demand? Think of your city like a boat tied to a distant tide. The tide is global dollar funding. When it pulls out, everything financed starts to creak. Rent is a financed asset, and delivery runs on financed fleets and fuel. When that tide shifts, your monthly bills shift with it, even if your block looks calm. Here's the twist. Your rent and delivery fees can rise even when local demand barely moves. Because your neighborhood isn't a closed pond, it's connected to a global ocean of dollars. When that ocean tightens, the price of borrowing rises everywhere. Landlords refinance at higher rates, and platforms fund fleets and promotions at higher rates too. The result is simple. Financed things get repriced, and you feel it as rent bumps and new fees. Now add the currency layer. When the dollar strengthens, imports often get cheaper in dollars, but pricier in your currency. Fuel, vehicles, and packaging are like oxygen for delivery and retail. Squeeze them, and costs climb. The Fed tracks the broad dollar index, and research it publishes shows dollar moves pass through to import prices. Meanwhile, the BES tracks FX swaps and forwards, the plumbing many institutions use to borrow dollars. When that plumbing gets expensive, the pressure shows up in everyday receipts. Let's open the machine, starting with the interest rate channel. When central banks hike, the global price tag on borrowing rises, like rent on money itself. Landlords don't set rent only from neighborhood vibes, they answer to loan resets and refinancing. In the US, the Fed's weekly H8 release tracks commercial bank balance sheets, including commercial real estate loans. When rates rise, that CRE lending environment tightens, and refinancing becomes pricier or harder. Translate that to your building. A 1% point higher loan rate can mean hundreds more per month per unit, so owners push renewals higher. Even platforms feel it because fleets, warehouses, and promos are also financed, and financing costs leak into fees. Now the FX channel, the one people feel but rarely name. Think of the dollar as the world's measuring tape for trade and funding. The Fed publishes the broad dollar index, and when it strengthens, your local currency buys fewer traded inputs. The BIS Triennial Survey shows huge FX swap and forward turnover, which is the plumbing many use to borrow dollars. If that plumbing gets expensive, the dollar rent rises for banks and firms abroad. Then, fuel, vehicles, and packaging priced in global markets can cost more in your currency. Delivery apps don't debate philosophy, they pass higher last-mile inputs into service fees and higher minimums. Finally, the risk premium channel, where geopolitics adds a hidden surcharge. Risk premium means the extra interest and insurance demanded when the world feels less predictable. One shock can widen credit spreads, so distributors pay more to finance inventory and shipping time. Shipping also has a fuel and insurance layer, and bunker fuel benchmarks are tracked by S&P Global Commodity Insights, known as Platts. When bunker fuel jumps, ocean freight gets more expensive, then trucking and delivery follow. Put it together, tighter dollar funding reprices housing, fleets, and inventories, even if your street looks unchanged. Your receipts are the tide gauge, not the weather report. The misconception says, my neighborhood is fine, so prices should be stable. The reality says, your neighborhood is a room inside a building, and the building's mortgage is priced in global dollars. When global rates rise, refinancing gets harder, and landlords raise rents to cover the new interest bill. You can literally watch the credit backdrop in the Fed's weekly H8 data on commercial real estate loans. A 1% point higher rate can turn into hundreds more per month per unit, so renewal season becomes repricing season. Another misconception says, delivery fees rose because apps got greedy. The reality, the app is a conveyor belt that runs on fuel, vehicles, and packaging priced through global markets. When the dollar strengthens, those traded inputs often cost more in your currency, even if your local demand is unchanged. The Fed's broad dollar index tracks that strength, and the BES shows FX swaps and forwards as key dollar funding plumbing. So the service fee is often a currency and funding surcharge, disguised as a button on your screen. Final misconception: one distant shock can't change my daily costs. Reality: shocks raise the risk premium, meaning lenders and insurers charge extra for uncertainty. That lifts credit spreads and shipping insurance, so distributors pay more to carry inventory until it sells. And when bunker fuel rises, ocean freight gets pricier, and the cost wave reaches your street. Platts publishes bunker fuel benchmarks, which help explain why nothing changed here can still mean everything costs more. So here's your mental model. When global dollar funding tightens, anything financed gets repriced, even if your street looks unchanged. This month, watch 3 gauges like a pilot. First, policy rates. Every 25 basis points is a small extra rent on money that can squeeze refinancing and push rents up. Second, the dollar and your exchange rate. A 101 move can quietly raise the local cost of fuel, vehicles, and packaging that feed delivery fees. Third, shipping and energy. Bunker fuel is the shipping world's gasoline, and Platts benchmarks help you see cost waves before they hit your receipts. If you rent, ask one question: when does your landlord refinance, and at what rate? If you run a shop, track one line item weekly: delivered cost per unit, because FX and shipping risk show up there first. If you invest, zoom out. The BIS tracks FX swaps and forwards, the plumbing for dollar funding, and the Fed tracks the broad dollar index. When those dials tighten together, expect more fees, not just higher sticker prices. And when they loosen, renewals and surcharges often stop rising before the neighborhood mood changes.